Let's get more from insights from the very influential voice of Stephen Roach from Morgan Stanley right now, who worked, of course, extensively in China when he was the chief global economist at Morgan Stanley, and he now joins us from Shanghai. Very good morning to you, Stephen. If I can ask, first of all, by a simple question, you, like Mr. Rubini, don't want to see these reserve requirement ratios. You want to see an interest rate rise, but everyone talks about it, but it's not happening, is it? When's it going to happen, and why aren't they doing it?
Well, I'm reasonably hopeful the Chinese authorities will move to increase rates by focusing mainly on reserve requirements. They're operating on the quantity side of the credit cycle, but they're ignoring the price dimension. And when inflation is spreading, as it is in China right now, the food inflation is up sharply, but CPI ex-food is now closing in on 3%. When it broadens out, you need broad instruments such as benchmark short-term lending rates, and they're just too low in China. At 6.3%, they're not even 1 percentage point above the headline inflation rate. They need to be at least 100 to 150 basis points above where they are today in real terms.
By not doing that and following your advice, therefore, what do you think is going to be the consequences of this inaction, if you like?
Well, I think they will do it. I think historically inflation has been very destabilizing for China. The authorities know this. They're very mindful of the difficult history in dealing with inflation. They are late to the game in terms of boosting short-term real interest rates. But I think if they start to move more decisively in the weeks and months ahead, this a particular delay in adapting tighter monetary policy will not have a major consequence. If, however, they refuse to tighten monetary policy for a variety of other reasons, I think ultimately the tightening will have to be a good deal more severe, and that would raise the prospects of more significant downside risks to economic growth in China, which is the last thing, of course, the authorities want.
Stephen, thanks for hanging on for us. If I can also talk to you about quantitative easing 3. You said before that your view of the US economy is a weak view. Therefore, there's a good chance of quantitative easing 3. But the quantitative easing 2 didn't really work. Now, if quantitative easing 3 happens, the impact on Asia is significant.
Well, I think the Fed is out of ammunition in terms of traditional or conventional monetary policy, so it's the opposite problem that China has. It can't cut the price of short-term credit any further, so it has to expand the quantity. But the main thing they're trying to do there is to boost aggregate domestic demand, and it's just not working with the American consumer. The American consumer is smarter than Ben Bernanke and is focused on paying down debt, rebuilding, saving, and is getting squeezed dramatically by record unemployment and underemployment, lagging income growth, and property assets that are underwater. So all this QE has done is just been to inject liquidity into markets rather than into the real economy, and so the Fed is lacking in any meaningful traction to deal with post-crisis America. And I'm not saying they won't do it in terms of another installment of QE, because they seem to be very focused on doing whatever they can. I just don't think it's going to work, and it could have negative consequences for the broader global economy.
So with quantitative easing 3 almost inevitable, you're saying, and monetary rates really quite low, and therefore that implies, you said before, another bubble that could end painfully, were your words. What is the fate of the US economy, or what is the fate, therefore, for the rest of the world as a repercussion?
Well, I just think we have to, sort of step back from the day-to-day, which is always hard for you guys, which you try to put an interpretation on every little tick in the market. But if you look back over the long sweep of economic and financial history, when you have a wrenching financial crisis, the post-crisis recoveries tend to be very weak, very anemic, and vulnerable to periodic relapses. And that's exactly what we've been going through in the last couple of years. We had a growth scare last year. about this time. We're having another growth scare this year, and I think we'll have growth scares for several years to come. When you have a weak recovery, you don't have a cushion that enables you to withstand those periodic shocks that always seem to come out and hit specific economies or the broad world. And with oil prices up, the Eurozone in trouble, the U.S. housing market, in another leg down, the problems in Japan, you've certainly had more than your normal fair share of shocks.
You mentioned all those just then. Mr. Rubini called it recently the perfect storm. He was speaking in Singapore of fiscal woe in the US, China's slowdown, European restructuring, as you mentioned, and also Japan's stagnation. And therefore the concern is, he says, everybody's kicking the can down the road of too much public and private debt. That can is becoming heavier and heavier and bigger on debt, and the problems will come to a head by 2013 at the latest. Is he right? Is a perfect storm arriving, or is that too much of a doom monger? He is, of course, Dr. Doom.
Well, Nouriel's a good friend, and I certainly share his concerns on the United States and on Europe. I don't share his concerns on China. I think the Chinese economy is doing just fine. There are obviously cross-currents at work in China, but I don't subscribe to the view that there'll be a hard landing in China in the year 2013. I think the government is very focused on shifting the macro structure away from the producer model to more of a consumer model, and that will put China in much better shape than the other major economies in the world.
You wrote a note actually back on May 27th. The China doubters are back in force. Are they wrong?
I think they are. I think China's got a very clear strategy, as outlined in the 12th five-year plan, to shift the model to more of a consumer-led model. They've got a commitment to that strategy that is deeply ingrained by their focus on labor absorption and social stability, and they've got the wherewithal to deliver on that commitment through reforms, through urbanization, through investing in human capital and innovation. So this is not the time to count China out. I think fears of a hard landing are seriously overblown in China today.
Stephen, a final question for you. The IMF new MD, Agustin Carstens from Mexico, comes to China on Thursday again to push his cause. Who do you think is the best placed person? Is it Christine Lagarde or the experience of Agustin Carstens?
I'm not going to weigh in on this beauty contest. I've known Christine Lagarde for a number of years. She's very impressive with deep experience. I understand the concerns that many economies in the developing world have for having one of their own representatives. I would hope that the ultimate choice would be on the basis of merit, leadership skills, analytical skills, and the ability to manage a large and complex organization like the IMF. This is a critical period for the global policy architecture, and the IMF needs the very best leader that it can achieve, that it can get in this environment, and that should be the ultimate criteria that shape the selection process.
Stephen Roach, thank you very much for your time this morning. Stephen Roach, the non-executive chairman of Morgan Stanley Asia, and a very highly respected economist he is too.